Hi, everyone. Welcome to Scaling Success, a podcast geared towards entrepreneurs, where we discuss a range of topics that contribute towards building a valuable and long-lasting business. If you're new to the podcast, please subscribe on Spotify and YouTube. I am Laura Moran. I head up marketing at Volition Capital, and I'm sitting in for Sean Cantwell today. I'm thrilled to welcome Peter Walker to the podcast. Peter runs insights at Carta, where he's focused on discovering key data and narratives across the private capital ecosystem. In a former life, he was a marketing executive for a media analytics startup and also led the data visualization team at the COVID tracking project. So, Peter, thank you for joining us on the podcast.
Laura, thrilled to be here. Thanks so much for having me.
Awesome. Let's get started just with from your words, from your mouth. What does Carta do and why is it a valuable tool for founders and startups?
Well, a lot of what we're working on today is actually expanding Carta past beyond where it began into a lot of different things around private funds. But when it comes to helping founders, Carta is an equity management platform. What that means is we help you issue equity, track it, and then eventually transact on it for your employees, your advisors, your investors, anyone and everyone that you're going to give a little slice of your business. As we know in venture capital-backed businesses, ownership is sort of the currency of the day. You don't have, you're not a public company, so you don't sell stock on the stock exchange. You actually grant ownership in exchange for money coming in the door to those investors. So Carta helps you in 100 different ways around equity.
And can you share a little bit more about your role specifically? Obviously, we just noted you head up insights, but What does that mean and why is there an insights team at Carta?
Yeah, I mean, there hasn't always been. So it's a fairly novel, I think, little part of the marketing team. So yeah, I run insights at Carta. Insights now is a team of 3 here. And basically what my job boils down to is because we are trusted by close to 50,000 startups now, the aggregated and anonymized data from those startups, things like fundraising, valuations, dilution, employee ownership, all of these things are useful to entrepreneurs and founders because they're kind of walking around in the dark, not understanding what the market reality is. So we realize that as a company, one of the best benefits that we can bring to founders is just exposing those aggregated and anonymized insights. So we publish newsletters, we write tons of big quarterly reports. I am chronically online when it comes to LinkedIn and Twitter, just like anywhere and everywhere where we can find founders and give them a little bit of data about what's happening in their world.
From a marketing perspective, curious, where are you finding, I guess, the most success connecting and reaching people? You just mentioned quite a few different channels and ways to sort of deliver those insights, but how are people most, I guess, interested in consuming or actually really digesting that data?
I think it's, you kind of use different channels for different, purposes. So certainly the primary place where I seem to live and breathe these days is LinkedIn. Tons of different little social snippet graphics, but the goal there isn't really to, give a founder an entire backlog of all the things that we have access to. It's to just garner interest and get people excited about the things that we can say about startups. And then hopefully, if you've found our stuff useful on LinkedIn or Twitter, you become a newsletter subscriber. We have about, I think the newsletter is close to 30,000 founders now, where that's where we dig deep on one graphic per week, what's going on in startups, how does it relate to the idea of building companies, and then you can expand into those big quarterly reports and everything. But I think one thing that, as other people have kind of come to me about the idea of starting insights teams, they often work backwards from, I need to publish a big old PDF every quarter, and that's the thing that I will use as my success metric. Whereas for me, it's much easier to say, just publish 3 times a week on social, see what the response is, and then ladder your way up to something a little bit more substantial.
Obviously, like you mentioned, Carta has access to quite a bit of data, unique data that not everyone has access to. But even within that, how are you deciding and picking and choosing, the ways that you're going to cut your data, what you're going to put a report out on? There's so much out there. There's so many different places people can turn. How are you, I guess, identifying what is truly unique stories within the insight that are insights themselves that are actually going to, be something someone can take and do something with versus, a top line headline that you're like, okay, good to know, moving right along.
Yeah. Well, that assumes that I am doing any sort of judgment on these things, which, I think that's very kind of you to make that assumption. Um, I think there's a lot of different ways to cut our data, just like there's a lot of different people out in the startup ecosystem that want different things from us. So one thing to note is that you're just never going to be you're never going to hit it 100% right for everyone that's looking. One of the most common comments on anything we post is, hey, this is great. What about my industry? What about my location? What about my, my specific team size, whatever it is. So you're always going to have different cuts. I think what we try to do is break it up into audiences. So when we're talking to early stage founders, the things that they find very valuable are the stuff they can't find anywhere else, which is safes and convertible notes, what's going on with valuation caps, et cetera. And then the big thing that I've been on for about, a year now, which is dilution. Just the concept of ownership. There are 1,000 different ways to cut ownership, but that is fundamentally the currency of these early stage startups. And that's what's difficult, when they go out to VCs or their lawyers, they get one perspective. But from us, they can kind of see, hey, here's what the general market is saying about how much do you sell in a Series A round, for instance. For investors, you can get a little bit more sophisticated early on.
Are there, I guess, any common ideas, common practices, sort of things that people live by that you have found in any aspects of the data or what you've been, pulling and seeing that are proving themselves to actually be not true, less true than people believe them to be, used to be true but are no longer true? Yeah. What are the trends that you're seeing?
Yeah, we can do a bit of myth busting, perhaps. Yeah. The first one that comes to mind, and this is, I want to preface this conversation by saying there's no morally right way to make this decision, but the question of founder ownership. One of the biggest sort of adages that is thrown around across venture is that you should always split amongst your co-founders equally. The data says that's not true. Actually, of teams where there are two co-founders, something like 58 or 60% split unequally. And in teams where there are 3, 4, 5, a lot of co-founders, equal splits are much, much more rare. It's actually pretty intuitive. If you have 5 co-founders, splitting 20-20, 20-20-20 doesn't actually make that much sense. So that's one of the things that we come up against a lot with early stage founders of they've kind of internalized, hey, if I don't split equally, someone is going to be hurt, or this is like an unfair way to run this business. Whereas there's no morally right choice. 50-50 is great, but you shouldn't just do that as a default. You should have deep conversations with your co-founders about what you think you each bring to the business. And if you come to 50-50, that's awesome. But it's not the like broad-based, it's not subscribed as much as people would expect it to be.
Does the data give you further insight into when it's not split 50-50, how like commonalities around how people are choosing to split it, unequally, or when and where one founder, gets more ownership versus another? Definitely.
So the median split for a 2-founder team on Carta is 55-45. So, we're not talking 90-10. It's not a gigantic gap, but there's one person that holds a little bit more equity than the others. And then as you get into 3 or 4 or 5 founder teams, what becomes very clear is that there's usually one founder that takes a bit of an outsized portion. So in a 3-founder team, that might be, 38 or 40% of the business. And that person, as you can imagine, is almost always the CEO. So there's like a stratification that happens there. The other thing that you have to take in mind when you're talking about founder ownership is not all founders or people that are granted the co-founder title, they're not all there at the very beginning, usually. So you can add people later on. And so the people that come on afterwards, if they come on within 6 months, there's not that much of a gap. But if they come on within, maybe this person has been working on this business for 2 years and then hires a co-founder, that second co-founder is usually given a proportionally smaller share of the business.
It also seems like, having that breakdown not necessarily be 100% equal is really nice for down the line if and when there's a tiebreaker situation, hey, we have to make a decision here. How are we going to do that if we're at a crossroads and don't agree? That somebody kind of has that, like, okay, when we get to that point, if we get to that point, I will be able to be the final decision maker in this group of 2 or more when everything else, has you kind of like stuck at that point.
I think it's one of the main reasons why it happens is decision-making clarity, both internally in the team. And then, of course, if you're raising from VCs, it's nice for them to be able to see that and understand, hey, how decisions work in this business. I should say, when we get over the initial shock of, don't split 50-50, and then we talk to founders about the various ways and means, the thing that comes up a lot, which some of them don't realize, which I think is even more important than how you split, is the vesting schedule. I mean, there are founding teams out there that don't have vesting schedules between the co-founders, and that is just setting yourself up for a really nasty potential outcome. In that if you don't have a vesting schedule and your co-founder and you go through a breakup, they're going to walk away with their entire portion of equity, and then that's dead equity that makes it very difficult to raise. So if you're listening and you're wondering, how do I split my equity? The more important thing is actually put a vesting schedule on everybody in the business, so that if they walk away, at least they're only walking away with a prorated portion of that equity.
I guess on the flip side of like, hey, what data has been surprising in that manner? Are there metrics and whatnot that people tend to turn to and put a lot of weight into, that anything in what you've seen has sort of led you to say, it's actually not a big deal. It's actually not a metric that, is an indicator of anything significant. Maybe pay less attention to that and more attention to, what's over here on the right-hand side.
That's a great question. I think I wouldn't go so far as to say this metric isn't important, but the way that founders think about the difference between valuation and ownership, I think is kind of backwards a lot of the time. So especially when it comes to a safe, for instance, and you're talking about the valuation cap of a safe, that is really just a figure that is an outcome. It is an outcome of how much you raise and how much ownership you're willing to sell, as opposed to being like attached to you emotionally. My valuation cap is $10 million versus $12 million, whatever. It's a supply and demand metric. So like you should be discussing, how much capital do I need? And then how much of my business am I willing to sell for that amount of capital? And then that gives you the valuation. You don't start with the valuation and work backwards. So that's one example. The other example that I think the other metric that is thrown around a lot is revenue. People are always asking about revenue multiples or multiples of any kind. At the very beginning, I gotta say, when we look at some of we have a little bit of revenue data and we try to like map that to the valuations. And at seed stage, it's just all over the place. Like, it's not like there's one, that everyone is valuing revenue in the same way. And it gets into the sort of inherent lack of fairness in some ways of venture, where a second-time founder with a successful exit can raise on a deck in a way that a first-time founder that has real traction might not be able to. So those tend to be very, very fuzzy at the very beginning.
Obviously, the last few years, we've certainly been in more of a uncertain economic situation. Not really, it's not necessarily a downturn. It's not necessarily not a downturn. Right. Kind of unclear what's happening at all points in time. But how have you seen that affect key insights, and have you seen any particular change in how and when founders are focusing on profitability?
Great question. So, I mean, it's obviously the venture downturn, such as it is, has had major impacts on tons of the metrics that we're tracking. At the most basic level, companies on Carta in Q4 of 2021 raised something like $70 billion collectively. Companies on Carta in Q2 of 24, the most recent quarter that we have full data for, raised 20 billion. So from 70 to 20. That's a massive drop. It's dictating a lot of the slowdowns in funding timelines, et cetera. And when we've had conversations with founders, it's pushed people in one of two or three ways. There's actually not one standard response to this downturn and this change in metrics. The first response is, I'm actually going to raise a bigger round. And I'm going to expect that it's going to take me longer. And I'm going to just kind of try to get as much capital in the door as I can now and like wait it out almost. The second is, I'm going to probably maybe not fundraise at the first and try, as you mentioned, to get to profitability or unit economics as quickly as possible. I think there's a subset of businesses for whom that's a great idea. But you really got to wonder, are those venture-backed businesses in the first place? Or should they just be wonderful bootstrap businesses that can grow at their own pace? I think it's Vinod Khosla who goes on about, if you don't know how to deploy venture capital, then you're probably not a venture-backed business, and maybe profitability is the right path for you, but you're not going to get to that billion-dollar outcome. And then there's this third path, which is kind of an emerging path where people say, maybe I take like one round of VC and then try to get to profitability and then see what happens. I think we're still too early to see whether or not a lot of those companies can execute the way that they want to, but it's definitely something I'm hearing way more often than I used to. Founders who are explicit about trying to get off of the venture capital wheel after taking one or two rounds.
Are there any other, AI certainly comes to mind, but are there any other major sort of cultural shifts, business workspace shifts that have occurred that you've seen, impact the core data that you're measuring in any meaningful, significant way?
AI is a huge one, although it's very easy, I think, right now to ascribe things to AI that may actually be more about changing mores on capital. So, you look at hiring, for instance. Hiring is way down at startups. In fact, total headcount is like basically flat for the last 12 months or so at Carta, across Carta companies. So on the one hand, you could say, oh, that's people eliminating roles with AI and taking over whole departments that are doing low-code tools now, et cetera. On the other hand, it's also, hey, people are just scrutinizing every single hire more closely because that's the impetus coming from their investors, et cetera. So it's kind of difficult to disentangle some of that. I think the message around capital efficiency is the biggest thing that has taken root in a lot of people's heads. Interestingly, we are starting to hear founders who come back to us and they say, okay, in 21, I was told to grow as fast as possible. And today I'm told to grow in a capital efficient way, and maybe profitability is more important than growth. But then I go back out for my next round and they're saying, you're not growing fast enough. And so people are getting caught in this messy middle. And I don't know if that has all been quite ironed out quite yet,
Yeah. It's confusing.
It's confusing. I feel for the founders who've been kind of like caught in this massive change. I almost think it's easier, more difficult in terms of fundraising, but easier to have started your business in 2023 or this year than it was to have started the business in 2020 and experienced the massive run up and then having to change everything.
And have the mixed message, or like sort of the big shift in approach.
Totally.
Yeah,
exactly.
I guess to that end, are there, looking into the future, coming to the close of 2024, looking into 2025, is there anything from an economic perspective that you sort of see or predict, if that's even, if you're willing to go there on where we're at or what founders can expect?
Yes, I am not a medical doctor or a lawyer, but I'm happy to project economist style into the future. The biggest thing, one of the things that I think is under-discussed in startup world, but is obviously one of, if not the driving force amongst some of this downturn, is interest rates. And we just don't talk about them as much here as we do in other parts of economics, but they are meaningfully changing the way that people think about investment. So if interest rates do decline, as there's some expectation they might, then you would have, I think, a corresponding rise in funding to startups. I think that's almost certainly true. What's going to happen absent changes in the Fed? I think that a lot of how do I put this nicely? There was a period of change where everyone had to adjust to this new world. So you saw companies that were perhaps overvalued have to take on down rounds at really high rates. Bridge rounds were all over the place. Just kind of people casting around for any lifeline to keep these businesses afloat. I think at the end of this year and into 2025, we've kind of over the hump of dealing with those changes. And now it should be a little bit more normal. The problem, or the downside of more normal, means if, venture capitalists are much more unwilling to give out down rounds and bridge rounds, there's still going to be a high degree of companies that are just shutting down and are unable to keep moving. But I don't think it's going to be as volatile as it has been the last couple of years.
Are there questions? Certainly get a lot of questions from founders, from entrepreneurs. You get questions in response to, the data that you put out. Are there questions that people aren't asking that you really feel like they should be?
I think one of the questions that founders need to be asking themselves I'll put out charts that sort of map the landscape of venture in terms of valuations and fundraising by industry. And I don't get any pushback really on the industries that are included, but in my head, I'm always going, well, there are industries that are just no longer on this map very much. And I wonder if a lot of founders have actually internalized that. So I'm thinking specifically of things like DTC retail, which was a pretty big sector in terms of venture capital funding in 2020 and is just like completely minimized these days. It's much, much harder to raise a round in that sort of industry than it used to be. And I wonder if some parts of the economy are just venture just doesn't actually play very well in them. Mm-hmm. And I think there's some aspects to that where the sort of attention and time and all the, brouhaha around AI has kind of left some places a little bit in the dust. And that I don't know if those are going to pop back, but I know it's a lot more difficult to build a business there on a VC-backed dollar than it used to be.
Do you think that's the expectation, like when DTC in particular, is it the expectation that that business is going to function a little bit more, from a dollars perspective, like a SaaS company than, a truly brick and mortar consumer business? And so the expectation on the VC dollars is just maybe disconnected from how the business is capable of existing in the long term, or is it other factors driving that change?
No, I think I think you hit the nail on the head. It's just whether or not you believe that these are fundamentally software enabled businesses, or are they kind of the same as they've always been and are not able to ingest VC dollars that way. Yeah. The other, I think that highlights something that I think more founders should also be asking themselves. VCs do this exercise where they look past their own stage. They say, okay, I invest at the seed stage. Who are my co-partners at the A and the B and the C, right? Who do I expect will take this company onward as I'm unable to fund them if my fund size doesn't dictate that? And founders don't really think necessarily all the way through the steps ahead. But I think that founders can actually give themselves a big advantage if they know, look, I actually am building relationships with my Series B investors, even though I am a seed stage company. I know what they're going to want. I know what the Series A is going to want. And I have like a map in my head of the full funding ecosystem. It definitely, it's a sort of more advanced take, but I think it can really behoove founders as they go into those funding conversations.
Yeah, that makes complete sense. And I'm sure you're right. It's a little easier to look at the short term than the long term when, you've got so many things sort of coming at you.
Yeah, I'm adding another thing to founders' plates, which I'm sure is they love. Yeah.
The ability to do that will get you ahead in the long run. Totally. What are you most excited about just sort of for Carta Insights looking, the next year ahead?
Really excited, maybe working from internal first. Like I am so pumped. I think that Insights at Carta, we now have like this established foundation where we've been very helpful to founders who need data. I think in the next year, there's two main things that we're going to do to continue that progress. One, and we just started doing this, we're going to start providing the same level of data for investors that we have been for founders. So data on fund performance, fund structure, all of these cool and interesting ways that emerging managers and other, more established VC funds build themselves. So that's an amazing data set. I'm excited to get into it. And then the second thing is, and hold me to this if this doesn't happen in the next 12 months, but what I'd like to do is build an interactive home for this data on Carta.com. So that any founder, they don't need to read my LinkedIn or whatever. They can just come to Carta.com and they can interact, so they can find what seed stage valuations are for their industry over time with their location. They can do all of that, like dancing through it themselves. So those are the two exciting projects for Insights coming up. Hopefully we democratize this data access even further.
Love it. I love the sound of both of them. I'm excited.
Yeah, it's going to be fun.
To check them both out.
It'll be eventually Carta.com/data will be where all this kind of stuff lives.
Perfect. We'll bookmark it now and time you on when it's live.
Apologies for whatever, weeks and months of 404 messages you get by checking that bookmark, but that's on me.
Is there anything we didn't cover that you think is highly relevant, need to say, need to get out, that's going to help, founders and startups be their best selves? I
think on a meta point, maybe building this insights function at Carta has been a really interesting experience in the value of a personal brand. I mean, like a lot of founders at the very earliest stages, I think, underrate their own capacity to be advocates. We talk about founder-led sales, but you can also do founder-led brand. And I think it is incredibly valuable to have be consistently in the ecosystem talking about the issues that your customers face or that your ecosystem is concerned with at that time. It has been such a wonderful thing to just kind of get in the bloodstream of startups this way. And when I talk to founders who are thinking about building their own insights teams or considering what they can do there, tons of businesses have really valuable data. Sometimes we overvalue how much someone would quote unquote pay for that data, but that doesn't mean you can't make use of it. So just an admonition for the founders out there that are thinking about an insights team, start one yesterday. It's been an awesome way to get Carta into the conversations that we wanted to be in.
Yeah, make yourself valuable before you need to
give value up front and it'll rebound back to you for sure.
Yep, absolutely. Well, Peter, thank you so much for joining us today and sharing all of your insights from your insights. It's been fantastic and I've enjoyed it and I'm absolutely looking forward to everything Carta has coming. So we appreciate you.
Oh, amazing, Laura. This is a really fun conversation. Let's do it again soon.